Are you in the market to buy a home? Well, we got great news for you, and I have a special guest to explain these numbers that you can hear on the news. So first of all, we got Brent Tallman here. Thank you so much for taking time to sit on here on this video with me to talk about these numbers that we're hearing on the news, especially today. So first of all, let's start with a little bit about your background. Tell us who you are and let us know what the Fed does regarding interest rate. How does that change mortgage rates?
Perfect. Well, thank you, David, for having me on with you. Really appreciate the opportunity to share this time with you. And honestly, people, if you're looking for a great realtor professional, one of the up and coming stars, David Zambrano is the guy to talk to. So very professional, treat you very well. So I'm honored to be here and thankful to have this opportunity. So I've been originating loans for over 14 years. And I just love to help people out, help them get into a better place financially and really build wealth for them and for their family. And owning a home is the number one way to do that here in the U.S. So I'm just thankful for that opportunity. Love to put pieces of the puzzle together and make things work for people. Love to see people be successful. And so I get to do that every day and thankful for that. Regarding the rates, so you always hear a lot, Feds are raising the rate 0.5 point, which they did today. And that was expected. That's exactly what they said they were going to do. And that's exactly what they did, which is fine. As long as the Fed does what they say they're going to do, things usually work out well. It's when they go off of what people didn't think was going to happen. That's when we get all kinds of squirrely situations. And so the question you have on here, do Fed interest rates changes affect mortgage rates? Yes and no. In a roundabout way, they do. The Federal Reserve does not directly control mortgage rates. It's not like the Fed said, hey, we're raising rates 0.5 point today, and now all of a sudden mortgage rates are 0.5 point higher. That's not the way it works. They control the fund rate, which is what banks lend each other overnight. So it's short-term money. And obviously mortgages are not short-term money, they're long-term money. But what they do impact is the bond market. And we are driven by the bond market. And so it either drives buyers to the bond market or buyers away from the bond market. And everybody was already anticipating all these rate changes, right? So, and haven't seen the press conference yet, but I know they're projecting rates in the rate hikes again in the future. And they're doing all this to slow inflation. And that is really the biggest driver of interest rates is inflation. So what happened today is actually, and what happened yesterday and what happened today is actually good news for mortgage rates. We're seeing the bond market is up 25 points already since the Fed made their announcements, which is good. Bonds go up, rates go down. So we'll start to see some of those improvements.
That's great. Well, thank you so much for the endorsement. I didn't pay him anything for that, I swear. But you brought up a really good point, inflation. We've been hearing that war since the end of last year, and that's what really started to increase the interest rates, and we've definitely seen the prices go up. I think the price for a dozen eggs, it's getting close to $8 nowadays. So how does inflation affect interest rates?
Yeah, great question. So it's pretty simple, actually, when you stop and think about it. So as the price of the price to do business, the cost to just live everyday life, as it increases, so it's going to make interest rates go higher. Because think, for example, if a big company was trying to build something, right, and all of a sudden that cost of the material has increased, they're getting money from the banks. So the banks need to price that in. So they'll start raising the rates. And they're doing that on purpose because what happened is inflation got out of control. So what the banks do, they start to raise rates, less money coming into the marketplace, that starts to slow down inflation, starts to stop the spending and things start to slow down. So they're intentionally doing this. I think in my case, they started doing it a little bit late, which I think is why we saw such a huge rate earlier in the year. I think in July or August, we had one of the largest rate increases in a long time. And so what's happened the last 2 months, November 10th, and then yesterday we got the consumer price index, and year over year it's gone down. And so as inflation goes down, rate's going to go down because the cost to do business is going to decrease. So as long as inflation would continue to rise, rates are going to continue to rise. That really is our biggest driver when it comes to rates is inflation. So we've gotten 2 consecutive months of good reports. And so I think the Federal Reserve is going to start to maybe not do as big as increases, but I think they're still going to continue to raise rates until they get the inflation to around 2 to 3%, which is what they would like to see. And it's actually heading that way, which is good, but we're still feeling it every day when we go shopping. I think they said the average from a year ago, we're up about $460 a month per family, and that's real money. That's in people's coming out of their bank accounts. So.
Absolutely. Thank you for that great answer. Rates at the beginning of the year, they were in the high 2s, and we saw those interest rates double in a year, which we've never seen before. So that is a great segue to our next question. What are the projections for mortgage rates for 2023?
That's a great question. And if I knew the exact answer to that, I'd probably be a multimillionaire and wouldn't be originating loans. I would just be telling people how smart I am. But no, so obviously we look at data. All the so-called experts, they study these things. There's people that literally, this is their life. They study all this information and they put it all together. And so nobody can 100% say for certain what's going to happen. But the projection is in the next 6 to 24 months, we're going to see rates back down probably into the maybe as low as the high 4s. I think we'll definitely see mid 5s coming back in the next 24 months. Exactly how long that takes to get there is really going to depend on what the inflation numbers do. The sooner that gets under control, the sooner the faster the rates are going to go down. So that's why they're saying 24 months. Now that could all change if inflation continues to rise. So I think probably by the end of the second quarter, I think we'll be looking at the mid 5s or higher, but there's no certainty for that. All this stuff can change. It's like liken it to, we all live in Florida, hurricane predictors, right? Hey, the hurricane's coming here. Everybody get ready. Then, 6 hours later, it's like, no, it's shifted over here. And so that's kind of the way it is. We're using data to try to predict what's going to happen in the future, and there's not an exact science to it. But overall, the rates are looking good.
Yeah, that's great news for people that are looking to buy. I was fortunate enough to be able to buy a home when the rates were super low, but also the investment properties that you actually helped me get the loans for, we got a pretty high interest rate. So my plan for that is when the interest rates come down, I'll be able to refinance. So
let me say something too about that, if you don't mind. So one of the things that happened, and what people have to realize is, because you talked about the low rates, the 2s and the 3s probably never come back. Those are like once in a lifetime situation. They were artificially created because of the pandemic and the economy being closed down. So that's why those rates got as low as they got to. They would have never naturally gotten there. I think to say high 4s, mid 5s is probably where rates are probably going to end up being. And that's probably a more realistic number and a sustainable number. And so I think that's one of the things that needs to happen, right, is our mind shift changes, because people are like, oh, I want the 3%. Yeah, probably never going to happen again. I could be wrong, but, hopefully not, because if it does, that means something big else is going on, right? We're shut down again, or, who knows what's going on. So I think 4s to 5s, even low 6s, I think is really a good, healthy place to be.
Absolutely. Yeah. And also to add on to that, the kind of market that we had before the interest rates were going up so crazily was the amount of buyers going above asking price, waiving appraisals, waiving inspections, which I did not recommend at all. And so it's a good thing that we have some inventory in the market so we can start looking to make sure that we're getting the right deal and the right home for these families. So that brings me to the last question. Everyone's trying to find, the lowest rates, the lowest prices at the right time, the perfect storm to buy that property. But when is it the best time to buy?
Oh, that's a great question. Matter of fact, it's one of my favorite questions. And I mean this with all sincerity. Now is always the best time to buy. The best time to buy would have been 20 years ago, right? When houses were 80,000 and all that. So the next best time to buy is now. And I sincerely mean that. And there's several reasons for that. Unless you know absolutely everything and you're perfect at predicting what's going to happen, you're never going to buy at the lowest, probably, and you're never going to buy at the lowest interest rates. And if you're sitting there waiting for the housing market to crash, I'm waiting for all these other things to happen. Probably not going to happen. And people are likening it back to 2008, 2009. This is completely different. That housing boom happened that housing crash happened because of easy credit policies. It's easy to get a loan. People were getting loans they should have never gotten. All that stuff's gone away. People also go, oh, well, I'm waiting for all these foreclosures to happen because of the pandemic and all these homes were put on forbearance and all that stuff. That's also not going to happen. Yes, it's true. Foreclosures are up this year, but that's only because they go year over year, right? Well, they couldn't. There was what is that called? You couldn't do foreclosures.
Right.
It was illegal. Like the government put a stop to it. So that's why you're seeing an increase in foreclosures. But if you look on an average year, you take out the pandemic, foreclosures are way down. Right. So I don't think that's going to happen either. And there's a lot has changed. One, banks are required to work with borrowers now. So if you can't make your mortgage payment, they have to make good faith effort to work out a deal to make that work for you. Obviously, you can't pay zero. That's unfair to the banks, but they do have to make good faith effort to try to help you not go to foreclosure, which wasn't in place back in 08 and 09. Plus, all the people that are getting mortgages now or got mortgages in the last 10 years, they were highly qualified, right? They had to meet stricter requirements, tougher guidelines. So people are in a much better position than they were. So housing market going to crash? I don't think so, especially if you're living in Florida. Demand is still way high. There's still more buyers than there is sellers. Yes, it's true. Our inventory has gone up a little bit, and it's made a big difference. And here's why I think even now, if you're like, well, hey, if rates are going to come down to say 5.5 in June, I'm going to wait till June. Here's the problem with that. If you could get a 6% now, and you can actually buy a house now, then do it. Because if you wait till June and 5.5, guess what happens? Every time the rates go lower and lower, more and more buyers are getting in the buyer pool, right? So now all of a sudden, the demand is even higher. Less supplies, more buyers in the pool. And so what's going to happen is we're going to hopefully not go back to that other situation you were talking about. But hey, now you got buyer wars, people doing the crazy stuff, going over appraisal, waiving inspections, and all that other kind of stuff. You can actually buy a house now and get seller concessions. Couldn't have done that a year ago. Almost every deal we have going now that involves seller concessions, of some sort. So your cash to close right now is a lot less. You're not having to pay over appraisal. A lot of cases you can get sellers to help you out with part of your closing costs, which you weren't getting. And if rates do go down, it's an entirely good possibility. Like we said, in the next 24 months, 6 to 24 months, rates are more than likely going to come down. You just refinance. Yes, there's some cost in that, but you need to weigh the numbers, make sure the numbers make sense, which is something that I do and that people at Fairway do. Is we look at the numbers and we say, hey, this makes sense, or we go, no, it doesn't make sense, and we'll wait, but we'll monitor that for you. And one of the things we will do that, David, for you and your clients is Fairway, the DeLand branch, we have agreed to waive or give you a credit towards the lender cost, which is $1,490, so almost $1,500 worth of savings off of your closing costs if you come back to us and we refinance you. So that's one of the things we're offering for people, because we do expect rates to go down and we know that people are going to want to refinance. And so that's why I say, really honestly, now is the best time to buy. And I mean that with all sincerity, because even if you look at appreciation rates, Realtor.com is predicting in Orlando 2.9% increase next year, just in appreciation. So it's not like housing prices are going to go down. And really 3% is a really healthy, that's a healthy market. You know, the 20-30% that we were seeing, that's a little crazy, not really healthy, and not sustainable. It's great if you owned a house, but not so much if you're trying to buy one.
Yeah, absolutely. And those are the normal rates. Appreciation should be going up 3 to 4% every year, which is another reason why people should own their home, because you're paying down your debt as well as your property going up in appreciation in value. So there you have it, guys. Thank you, Brent, so much for your time and all your knowledge. I always love talking to you because every time I get on the phone, I get something new and I keep learning. And that is the thing that I enjoy the most about real estate, is learning so I can help people make the right decisions. So there you have it, Brent Tallman with Fairway Independent Mortgage. If you need to reach out to him, the number's on the screen, 386-801-7362. If you like this video, go ahead and then hit the like, subscribe to my channel for more information about the real estate market and how you can grow wealth through real estate. Until then, have a great day.